Hey everybody, this is Jose. We are about to get started in a little less than a minute. This is a sound check, as we always do. Please go ahead and have a quick and nice message on the chat box, just saying hello, so I know that you heard me, and we are ready to get started. All should be good. I see the sound coming on my end, so it's all looking normal. But again, always good to have this extra confirmation before we start. So please do that as we are getting ready to begin. In the meantime, I will turn on the video stream so I can say hello from here, bottom right corner of the screen. How are you, my friends? Good to see you. Chuck, how are you? Good to see you, my friend. Very nice. Okay, 10 seconds to go. Almost there. Christian, how are you, my friend? Hope all is good. I heard you had a few issues recently, so I'm hoping all is good on your end with technology and stability of computers, which this happens to all of us, I guess, at some point, where we love and hate computers at the same time. Anyway, we just hit the top of the hour. Thank you guys for confirming sound is good. Let's begin the session. Welcome to Options with Options. My name is Jose Blasco. Today is December 8, 2021, and we are ready to trade options, as the name of the session suggests, for the ones of you who are new, the ones of you who are regularly attending the sessions. Obviously, you know what we're doing, isn't it? Before we get started, I'm going to highlight the disclaimer on the upper left side of the screen. Please read it carefully. This is important information. How are you, Ahmed? It's good to see you, my friend. Very nice. And as the disclaimer is being highlighted again, do not skip it. Make sure you read it carefully, as it is important. The plan for today, as always, we'll be looking at the market, understand what's happening out there, look at the positions that we currently have, and from there start planning on new trades, new positions, and get them executed, assuming they meet our rules. Okay, that's the plan. So let's begin. Cool. Quick reminder, as always, tradewithufos.com/Jose. Make sure that you utilize the page of your instructor. Okay, so if you're attending, for example, a stock session with Becky, use /Becky. If you're attending a session with Boyan, use /Boyan, etc. So, and then you come in here when you have questions and you log in using the username on your website, and then you click Ask Question to be able to type the questions you may have. I would recommend, before you do so, to search, because maybe the question that you have about trading, about the use of the platform, about whatever it is that you have, may have been asked and answered already in the past. So the answer may be waiting for you. Actually, you don't need to ask again. So make sure you use this tool, as it's quite efficient for us to kind of coordinate as a community and basically help each other, because your questions are indeed very valuable for other traders as well. Just like prior questions are indeed very likely very valuable to you too. Cool. So with that said, we're going to jump into top and begin with the SPY. This is the chart I have loaded in front of me right now, the S&P ETF. When looking at this market, we can see that we are in a daily time frame. We just changed yesterday, if you wish, because of yesterday's price action. So today we are now in a confirmed climate to the upside. So statistics suggest that we just got started with one candle. Statistics suggest that a normal duration for this climate would be 6 candles moving higher. Of course, today the market is down by 0.3%. Obviously, climate doesn't mean going up in a straight line. Climate, maybe ups and downs. Okay, so for example, here is going down, here is going up, is being supported by the moving average. So this is an up climate. Okay, this is just a comment for the new members in our community that you may be newer to our sessions. So you just understand what climate means. We are at the very beginning of a climate, so there is not much to discuss really. 0.65 is the most the climate has extended. To expect a change of climate, we would need the climate to reach 0.77. We haven't got there yet. So in that sense, it's pretty okay. It's not anything too out of ordinary. It's pretty normal. Okay. So we'll be looking into this more in depth in a moment. Okay. Now, let me do this. I'll come back to the chart in a moment, because I was going to say two things at the same time and that wouldn't work. So let me take a look at the volume map first. Notice how the volume map is presenting on the front wick a very neutral type of amount of trades, both on the call side and the put side. The ratio is 1, and they're both surpassing the average. But you can see how the next expiration dates have a little bit more of a load on the call side, and the next expiration date actually is surpassing already the average for the calls, but not for the puts, which denotes from behind the scene a little bit of a bullish sentiment coming in, but coming in probably into next week more than this week. Okay, so we may see this week the market have to fall maybe a day or two before it resumes and start going higher. That would be my interpretation of the volume map in here, which also you can see when we look at the DT volatility comparison. We look at the implied volatility of the calls in blue color versus the implied volatility of the puts in gray color as an average, a 3-day average. And you can see how the puts are above the calls, meaning that there is still some bearish action out there when it comes to how derivatives are being bought and sold, which imply either more buying of the puts or more selling of the calls or both, which in both cases that's a bearish thing. Okay, so that's happening right now. And again, that's why these together with what we just saw on the options map, I am kind of forecasting the market going down a bit, and from there resume and continue the up climate, which is likely going to last for 6 candles based on probabilities. Okay. The other reason why, which is the second reason, I said that probably the market is gonna have a little bit of a trip to the downside, is because when you look at the 55-minute time frame of the S&P, there is no green UFOs at all until we get to 459. Okay, so we may need to see that market to fall, relatively deeply before it resumes. Okay, and that's what I'm expecting in that 1, 2, 3 days this week before we get into next week. That would be a pretty normal thing to happen, unless next thing you know, we have intense buying, green UFO shows up, and that would likely translate in, and we'll check that tomorrow, that will likely translate on the implied volatility of the calls, blue color, to then be above the gray color, which is the implied volatility of the puts. And then, of course, the market condition has changed, and now we can be a bit more aggressive, relying to the upside. Right now, a little bit of caution while we are in a brand new climate, little bit of caution, there is still bearishness from behind the scenes, as you can see. Mark, good to see you, my friend. Mario, good to see you as well. Good to see you all. Cool. Okay, so this is what we have from the S&P point of view. If we look at the VIX, the VIX is trading at 22 right now, much lower than the prior days. So that is good. If last week you were working intensively on putting together non-directional trades, as we said, those trades should be doing quite okay. Okay, we're going to be reviewing the one that we placed last week, which is Facebook, which, by the way, is giving us a very good opportunity today to discuss about position tweaks, converting an iron condor into an iron butterfly, and things of that sort. We're going to be doing things of that sort today, given the major move of Facebook to the upside that was beyond what probabilities would have suggested. So we're going to take a look at that in a moment, okay? But anyway, I'm about to start reviewing positions. If there is any question about the market analysis I have just done, please let me know. Hi, Christian. You have a green UFO at 465 in the 55-minute time frame. At 465, there is no market data there, so that must mean that you are looking at. Let me show you the format. You may be looking at the data from all sessions. And if you are looking at the data from all sessions, probably, here we go. Here's your UFO at 465. This is a UFO that was formed during either pre or post market, or the combination of pre and post market data. And nothing wrong with using it. You can see the probability is still 55. The perfect way to actually do your market analysis really would be to use the S&P futures. That would be even better than looking at pre and post market. So to me, I kind of prefer to go to one extreme or the other. So if I want to see all market data, use futures. If I want to see less market data, then just use regular market hours trading activity. So, which is what I do when I uncheck show all sessions. Okay, cool. Okay, very good. We have it. So now, so let's continue what we're going to do with positions. Good question, Christian. And we're going to start with COF. Okay, so with COF, we've been doing a collection of things. This trade started, with 3 legs. Then it was converted into, even though we have multiple legs here, this was just for me to show you what I did. But basically, this was a bull call spread at this stage, if you recall. And here now we took the bull call spread and then we sold another call and bought a call higher, which basically we butterflied that bull call spread, becoming a directional call butterfly. Okay, so if we look at what this trade is currently doing using a race graph, okay, and if I was to, let me float this. So if I was to also look at COF on the chart, so we see what that stock has done. Okay, maybe I can move it here. So you can see the stock went down aggressively. Let me move this here because I had exactly, that's what I was looking for. So we were relying on one of those speed bumps. The stock went violently against, and now it's coming back, and that's why we worked on what we did on doing what we've done to manage the risk of the trade. And now the beauty is that when we look at this trade, the worst case of the trade, it's to make $58. So worst case, no matter what, this trade is going to make 58. So the current P&L of this trade is actually 68.5, okay? And that's assuming you're going to be able to exit at a perfect price. So what should we do? If the maximum profit to be made is 58 and currently we can exit at that price, what should we do? Well, we should try to exit now instead of waiting. And why would that happen? How can it be the current price is surpassing what the maximum P&L is on expiration? Well, that is due to the beauty of implied volatility, where in certain cases, certain strikes have gained more implied volatility, and therefore they are now beyond the price that would be assumed by the pricing models. And therefore, the real-time P&L shows 68.5 instead of 58, okay? Now, having said that, which is real, is there and is to be caught if possible, the reality is that catching that, it's normally quite difficult because what the market makers are going to do is they're going to widen the spreads by that amount. So if you try to exit, they're going to keep the difference between the theoretical exit price to that additional temporary spice that we have available in the trade. So again, if you are dealing with a stock which is super liquid, I would say it's worth it to try and get filled. COF is not the most liquid stock in the world, so then my recommendation here, even though you see the P&L a little higher than 58, my recommendation would be just leave it alone and wait until those options expire. In this case, in January 21st. In parallel, we also have this opportunity, which is if the market rallies, okay, and approaches 179.40, which is the midpoint, which is where we sold the two units. Okay, the two we sold right there at 179.40. That's when we are likely going to get the best P&L possible, which based on probabilities, you can see the purple line. The purple line is here. It doesn't look like we're going to reach that high, but we've seen this happen before, right? Probabilities are there to give us a reference. They are not a guarantee for the good or for the bad. And therefore, given the fact that it's going to be very difficult to exit this trade for a price which is better than the maximum theoretical P&L, I would say it's worth it to leave it alone and just have an alert at 179.4 in case price reaches there, so you can exit safely, okay? But anyway, yeah, that's what it is. Nothing wrong if you guys want to place a very demanding order and try to exit this trade for the maximum profit and you leave it there the whole day and in the end you get filled. Could be, because you could have another excess of volatility coming in some strike, and next thing you know, now you get the price you wanted. I would say it's quite rare, especially in a case like COF, but if you want to practice this, I think it's certainly a good practice. So from a position review point of view, I would say we leave COF alone. Okay. When we look at COF on our TOS account, it's showing $10 of profit, which is very little, but remember it's more than that because we have accumulated prior profits and closes before. So the net added, it's 68.5, assuming that we all got the same price, which we may have slightly differences depending on when you executed this trade. Okay. Cool. The next one after COF, and please stop me if that was too fast and you need a bit more review. So the next trade after COF is Yelp. Okay, Yelp is currently showing a P&L of negative 55 after the tweak. Again, if I show Yelp here, it shows minus 120, but it's the same story. It's minus 120 is what you have in the account now, okay, which is basically a butterfly. Okay, that's what you have in the account. You have a butterfly. Wait a minute, I was confused. I thought we started this trade with puts. No, this trade was started with calls. Okay, directly with calls. So then that minus 55, to be honest, should be coinciding with the minus 120, and it doesn't. Okay, and that is probably because of how top and TOS look at the bid and the ask prices and the algos that are being applied to try to replicate market conditions, where of course we have a pretty important divergence now between what TOS is doing and top. And the reason why is because Yelp, in using those strikes, is lacking great levels of liquidity with a bid price of 440 and an ask price of 530. That's pretty bad. And therefore, so there are certain assumptions on TOS that seem to be more pessimistic when it comes to the price you would get when exiting the trade. And if you were to exit the trade, top is being a bit more optimistic about the price you would get, and hence the minus 60 PNL versus the minus 110. Okay, so that's the reason why. Okay, but yeah, we butterflied it. You are correct, Christian, and that's the position we have. So if we were to look at what is the risk profile for this trade, okay, and I load the chart as well so we can see. So Yelp. Okay, so I remember we entered this trade using an intraday chart. I think it was the 89-minute time frame, and notice how we entered, and the stock went very much against us, and then it's kind of coming back. So again, if it keeps going higher and ideally it reaches all the way to 43, 43 is the midpoint of our butterfly, and this is where you would find the greatest amount of profitability. But it doesn't mean you need to reach there to find profitability. It seems that profitability will be found as we are reaching 36. Sorry, that's the break-even point on expiration. Sorry for that. Profitability real time before we get to expiration would be around 38 or something like that, 38 point something. So if that stock keeps rallying for, let's say, another dollar, we're going to start seeing PNL, which is profitable. And then, of course, if the stock continues, so the most you will make is around 43. And if you were to reach 43, of course, get out. Okay. So another trade that is doing its thing, and another trade that we have in the portfolio, which is to be left alone. There is nothing to be done here. It's all good. The next trade to discuss, and please stop me there again with Yelp if you have any pending question. I know some of you are in this trade, so let me know. We have CSX. Okay, CSX. So this was a bullish trade. It was a bull put. Okay, it was a bull put, which was an in the money bull put. Okay, and I will show this and this. So we entered this trade that day at that time. That market went against us badly, and then this market rallied. And yesterday actually hit our target. Now it's below the target. I was tempted to close it yesterday actually, and I'm like, okay, market looks quite bullish, so we should be there. We should be okay tomorrow. And indeed, the market opened inside the speed bump, but now it's outside. Okay, so now I'm late to the party to exit the trade. I'm still gonna exit the trade for a less of a profit than expected, but I'm still gonna suggest to exit because this trade did what it was supposed to do, which was to reach that target. Okay, so how many of you were in the trade? How many of you closed the trade? This trade for me, I'm going to exit it for a $10 profit, so it's nothing too major. But yesterday it was looking so much better. So if you guys were in this trade and you exited, I'd love to know. And if you are keen on sharing your execution prices, how much you got, etc., that would be great to contrast and compare. And as a learning piece of information, that would be very useful for the other members in the room. Okay, Christian, you're still in it. Okay, you're still in it. Got you. Is it because you have a different plan for the trade, or is it because maybe you were just waiting for the session to happen, and since I planned the trade, you were just waiting to listen to further instructions? Because again, the one thing that did happen here very clearly is that we hit the target, right? So this is a trade which I'm gonna close right now. Okay, so I'm gonna buy. Okay, and the midpoint is 1, so I'm gonna try to get filled at 1 and see what happens. Okay, so yeah, I just got filled at 1, so I am out of CSX. This trade is now over. Okay, cool. Was not a very special trade, but again, by exiting yesterday, it would have been obviously much better. Next trade to analyze. Okay, next trade to analyze is Philip Morris. Okay, and this is another trade that worked well. This is another trade that actually, based on what I saw yesterday, I was thinking we need to exit this trade, and that this one is a bit more kind to us because it's basically at the exact spot at which we wanted to exit. Okay, so if you recall, when we entered this trade uh, on that particular day, we were shooting for a pretty near target located where the speed bomb is. Now, we surpassed the target by a lot. Okay, that was the week of Thanksgiving, if I'm not mistaken. Got you, Christian. I'm reading your note there. That happens, my friend. Okay, that happens, but it's okay. It's all good. So if I'm not mistaken, that was the week of the Thanksgiving. So we didn't meet there for a few days, and then when we met finally, so then that stock was way past the target. So what we said is that, well, we should be out of the trade, but at the same time that's a good problem to have. So let's try to add more profitability to the trade by butterflying it, and that's what we did. Okay, and we didn't butterfly it by using the same technique that we normally did. We butterflied it by using options below because we were already in a profit. Okay, so you are now out for $19 of gain per contract. Very nice, Christian. Nice to hear. So now, like all butterflies, it doesn't matter if you butterfly something for a profit, for an extra profit, or to mitigate a losing trade. Then the midpoint, which is where you have the two short units, in this case is 90, that's the ideal exit point for the trade, where you tend to maximize the profitability. And guess what? Philip Morris is currently trading at $19.19, meaning that it's time to get out. Okay, so this is another trade we're gonna close. I just wanna graph it first so you get the visual, but this is a trade also for us to close now because we are meeting the rules for us to exit. So we are making around $100 per contract on this trade. Again, notice how the maximum is here. Could you stay longer and accumulate more time decay? Yes, but the price to stay there and wait for longer, it's that you may get that stock to now move aggressively in whatever direction, and whatever direction it moves is going to give you a very similar P&L. And if it moves too fast, now you start giving money back to the market because of the negative gamma that would be produced. So not a good idea. Yeah, and therefore we are just gonna go ahead and remove this particular trade, close it, and this trade will be over. Okay, so I'm just gonna look at Philip Morris, which is here. Is looking at $88 here. Earlier it was showing more like $100 in the simulation. Let me select the three legs, right click, and create a closing order to sell this butterfly. Okay, and the midpoint seems to be 60. Let me take a look at this again one moment. Raise graph. Okay. I'm just analyzing this a bit deeper. Just give me a moment, guys, if that's okay. Yeah, correct. So we are selling the 87 and selling the 92, and then we are buying back the 290s. Okay, this is correct. Okay, this is correct. So I'm gonna do it for that midpoint, which is 63. I'm just gonna confirm and send. Okay, and we're gonna go ahead, send that order, and wait for it to be filled. We just got filled at 67. Okay. Notice in this case the trade. This is why I was revisiting the trade when placing a closing order with TOS. This happens sometimes. I remember there was a case. This happened to Maca. I don't know if Maca, you are with us today. When selecting this was a trade for a credit, so buying back is actually something you need to do to pay. But when I right clicked and I selected close, which I cannot do now because the position is closed. So the type of order it gave me, and you can see that with the background, it's a credit, okay, a credit with a positive number, which is the same as a debit. But the TOS system is looking at it as a credit. And therefore, even though my price was, I believe it was 62, I got a little bit of slippage there, or all the way to 67. Okay, so careful with that, especially with brokers like TOS, because it's a bit tricky. This trade was entered as a credit, then we added a debit to build a butterfly. So now when you try to exit the whole thing, it's almost like TOS remembers the last step, which was a debit, and tries to get you out for a credit, where the reality is that to get out, you need to pay, because the whole trade created a credit, not a debit. So I don't know if I drove you crazy. You may need to watch this recorded again and listen to it carefully, but keep that in mind when you do it, okay? And an alternative to avoid the slippage is just to close the units one at a time, so you don't get TOS to color either red or green the execution, meaning calling it either a credit or a debit, and you force what is it that you want to buy, and you force what is it that you want to sell, and you set those limit prices, so you get filled with the least amount of pain as possible, okay? Keep that in mind. Again, with other brokers that may not happen, but with TOS it does, okay? Cool. Okay, so we are out of this trade for around anywhere between $100 to $88 of profit, something like that. And the trade is now over. And the one that is left for us to analyze, and that one we need to work on it. It happened to you too, exactly, Mark. So careful with that. Yeah, careful with that. And the last one here is the short Iron Condor with Facebook, which is a trade that has been moving against us today aggressively, and we need to talk about it, and we need to actually act on it to mitigate the problem, even though it may not be a problem, but maybe yes. So we need to check. Okay, so when we did this trade with Facebook, okay, and by the way, it's muscle memory has me call this company Facebook. I should call it the Meta. Okay, they're not Facebook anymore. So the idea that the idea we had on our mind is that we started the trade on that day. We were relying on a statistical range located here, and we are relying on UFOs located above and below, meaning that the real problem comes if you were to reach the purple areas, which is the extreme of the red and the green UFOs on an intraday time frame. So notice how, for the duration of the whole trade, Facebook has been behaving very nice until today, where we are now above the red line, which was the statistical calculation that we made. That was the break-even point, and the statistical calculation that we made, that above that red line, then it's problematic. Okay. Now, of course, it's not that problematic because we have UFOs that are likely going to bring the prices back down. So it's not the end of the world. We still have 2.5 days to go, and the trade may end up fine. But at the same time, what if that stock keeps going higher? Probability suggests that when reaching expiration date, we may end up trading around this level, which is above the gray line. Okay, and that's the level because you can see the indicator lines are here. Okay, so that's more or less, and I apologize for the lack of precision with my drawing, but you get my point. So we may get there. I'm looking at the vertical dotted line, which is right there, which represents Friday expiration, and I'm looking at how that intersects with the probability cone. Maybe that was a better drawing now, not the best still. But anyway, you got me, right? So we are now triggering a trouble condition, which the trouble condition is when our probability cone crosses our purple line. Okay, that's the issue. So if the probability suggests that our protecting UFOs, which are located between the red and the purple line, okay, are going to be violated and traded through, if probability suggests that, so we need to switch from doing nothing to damage control mode. Okay, that's what we should be doing. And how do we do that? Well, we have different actions to be taken. Okay, different actions to be taken. So one of them, okay, if possible, is to roll the puts up and wait another day. And then if the next day you are still beyond the purple line, then convert the Iron Condor into an Iron Butterfly. But of course, that is assuming we're going to have the UFOs in the right place and assuming we're going to have the strikes we need. Okay, so let me draw it on the screen because it's a while we have not done this to an Iron Condor. So let me do a little bit of explanation on the screen and then I'll do it. Okay, so An iron condor is made of buy a call, sell a call, sell a put, buy a put. This is what we currently have. Okay. Now, because the stock is going higher, the side that is in pain is the call side. So we need to try to help the call side to defend itself by giving the call side more premium. Okay, more premium. How can you give the call side more premium? Well, the only way to give the call side more premium without taking more risk on the call, because you could sell more calls and now you get more premium, but now you take more risk on the call. So the only way to do that would be to close the current puts that we have, close them, and since the stock went higher, those lower puts will be closed at a profit, and then turn around and sell another bull put spread at a higher level, collecting new premium, which is going to be a bit more than before because they are higher strike, so then it's a bit more premium. So what happens now, if in the end the stock goes all the way and you lose all the way on the call side, well, all the way is actually all the way minus the new premium collected. So you are reducing the risk. So you are trying to alleviate the problem. Again, we are in damage control mode. It doesn't mean we have a magic formula to remove and transform a problem into a profit. That would be great. What we're doing so far is trying to mitigate risk, and give the trade a second chance. What is the second chance? Well, the second chance is that, number one, we mitigate risk by rolling the puts higher, and then if the stock behaves a little naughty like it's behaving by going above the red line, but then comes back down thanks to the UFOs, so now the stock is back to where we need it to be, and now we're going to profit, right? So we are giving the trade a second chance. But at the same time, if the stock was to not to come back and just keep going, so now the total size of the loss would be reduced. Okay, that's what I mean by damage control mode. Okay, now we have a series of rules which I'm going to repeat in a moment on where to locate those puts. But before I repeat those rules, let's pretend I cannot do that, right? Because I don't have any put that meet my rules. I don't have puts available, whatever that is. So then the last step in this defense would be to go ahead and where the call is, we will now sell a put and then buy a put below. And that, if you think about it, that is, my friends, a butterfly. Okay? And what the butterfly would do is that it would reposition the profitability section to be somewhere in this area, meaning that, if the stock now surpasses the purple line, you may still end up in another place higher than the purple line, but you're still in profit. Okay? So you are giving the trade a second chance and reducing the risk even more because, of course, the nearer the puts are to the call, the greater the premium you get. So the closer the puts, the less the risk you remove, the less the risk that you remove. Sometimes, if you get lucky and premiums went very high, actually you can turn a loser into a profit, but that's rare. But again, by going to the put, which is the nearest to the call, you reduce the risk by the greatest amount. Some of you may be like, okay, so why don't we do that all the time? Well, because there is a trade-off. And the trade-off is that if you reduce so much the risk, then your profit zone remains very, very small. So you may end up with a profit zone that looks, tiny, sorry, not like this, more like this. And now you have to see the stock expire within that box for you to profit. And because the box is so small, the probability of being above or below, it's very low. And below is very painful because below is the area where if you didn't do damage control actions, then you will profit. So you don't want to make that zone too small because then it's going to be very painful to see that the stock went back way, way lower. And now next thing you know, instead of a profit, you got a loss because you got too fearful when it comes to removing risk. Okay, so we need to remove risk one step at a time based on the rules I'm about to repeat. But that's kind of like the process. Okay, since we are being hurt on the call side, let's roll the put side all the way to, if needed, we become an iron butterfly instead of an iron condor. Can I get some confirmation from you guys and you tell me that you are with me on what I just explained? So this is well understood because it's quite critical. I know some of you have been practicing this, so I'm pretty sure that among some of you, this is very, very clear, but I am also pretty positive that to some of you, you have not had too many chances to practice it, or this is new, and it may be a bit on the confusing side, okay? Thank you for that, Joe. Thanks for that. So, Chuck, yeah, got it. Wonderful. So let's evaluate, okay? Because in the end, we need to evaluate things, okay? So I'm gonna right-click on Facebook. I'm gonna go for a risk graph. Okay, so this is our risk graph. Okay, so again, this is the P&L we currently have. Okay, we are underwater by $140. Okay, this is what this trade is doing now, because we are beyond the break-even point, and therefore we are suffering. Okay, of course, notice if price comes back down, 327, for example, so that's it, you're back in business immediately, right? So we don't need to feel like the world is ending here. It's a pretty normal scenario. We just need to manage it to try to again find that balance between what if it doesn't come back, let's reduce the risk. What if it comes back, let's give the trade a second chance. That's what we're going to do. Now I'm going to create here a compare spread. Okay, and we're going to copy the primary spread, and we're going to do a series of things. Okay, but before we do that, I also need to look at the chart and see what is it that I can do. Okay, let me float the risk graph so it's not there in the middle. So what is it that I can do, right? And in order for me to decide where to move my puts higher, the rules that we have are very much in line with the rules that we have when we are building the Iron Condor for the first time. Okay, so we are looking, I'm pointing at the expiration date, and I am pointing at the probability cone, and what I'm doing is I'm drawing a red line across. Okay, because that red line now suggests that from now until Friday expiration, the market is likely going to stay above this line. Okay, probability suggests so. Okay, so I would like to find in an intraday time frame at least a couple of green UFOs, okay, above that line, and that way that would help me very much to redefine a new location for the puts. Okay, so let's take a look. I'm loading a 55-minute time frame now. I have that new red line here. Okay, and notice that with that red line here, okay, the new location for UFOs, okay, the new location for UFOs would be right here. That would be the new location. I got two UFOs. They are 51% probability. We need 48% or more. So these are my two UFOs. Okay. If you want to be a bit more prudent, you can also look at this one below here at 307. So since I'm going to explore what's available on the option chain, and we are approaching expiration, some strikes may start lacking liquidity. So I'm going to give myself the opportunity to check 312, 305, and see what is it that I like better. Okay, but now coming back to the daily time frame. So the puts that we sold were somewhere here. We can now roll puts and sell puts below this new purple line or below that purple line as well, because those purple lines are beyond what probability would suggest and protected thanks to two green UFOs in an intraday time frame, which are ready to defend the trade in our favor, even though it's not going to be a guarantee. It's a great defense, isn't it? So let's take a look at those values. Again, we are talking about 305 and 312. So let's take a look at, if we were to do that, what would be the result? Okay, so first, let's simulate. I'm going to close the puts. To do that, I'm going to add an options leg. Okay, I got the puts on the top. So first, I am buying the 285. So what if instead of buying the 285, I sell the 285? Meaning I close it. Okay. 285 put at the current price, which is the midpoint. Okay. So what if I close the 285? Okay. And what if I buy to close the other put, which is the 290? Okay. So if I take the 285, I take the 290, which I bought and sold, and now I reverse it, I sell and buy at the current price. If I click OK to that, this is going to leave me with a better call spread, which is the risk profile that you can see here, which is the orange risk profile. And that is going to put me in a position where the P&L is the same, because I'm closing it now. So I'm not adding anything. I'm just closing it now. So the P&L is the same. And my risk level, it's basically about the same, because, notice how those puts are trading at 4 cents each. So there is extremely little left in them. So I'm exiting this trade, and I'm basically staying in the same position with no addition of any damage control type of feature. So what if I want to add a bit of damage control? Well, remember we said we're gonna add two more options. Okay, I'm going to sell one, I'm going to buy one. Okay, and we said we can use 312, we can use 305. So let's begin with a conservative 305. If I do 305 and below, I do 300. Okay, 305, 300. So basically what I'm doing is the 290, 285, which I had before, I am now replacing that using the 305, 300. Okay, and what we don't know is that going to be liquid? Is not going to be liquid? How much is going to pay? So that's what we're going to observe. And as you can see, it's not too interesting. If I zoom in, the 305 would pay us 10 cents. The 300 would pay us 7 cents. So we would end up with a net additional credit of 3 cents. And for us to do that, we need to close two contracts and open two contracts, which is almost like you're going to pay more in commissions than the new premium you are getting in. So that tweak is not helping from damage control point of view because we are too close to the Friday expiration. That strike 305 seems to be a bit too far, and therefore we are not being paid in a way that helps the trade at all. Okay, so what I'm going to do? Well, be a bit less conservative, and instead of 305, I'm going to pick something the closer to 312 as possible, and then 3 strikes below, that 5 strikes below, that's going to be 307.5. So I'm keeping the same distance of $5 like I had before. Okay, 312, 307. Let's see what happens. So what is this giving me now? So it's still not amazing at all because the 312 is giving me 21, the 307 is giving me 11. So I basically gain 10 cents. I gain $10. So yeah, well, fair enough if I go back and make this graph a bit larger. So you can see, sorry, let me add this. Here we go. Let me float it now. So you can see, here we go. You can see that the orange graph, okay, basically would lose, worst case, 380 instead of 388. So there is a little bit of an improvement on risk management, but you can see it's basically not worth it, isn't it? You're gonna pay commissions just to save yourself $8 when the risk of this trade, the maximum risk of a trade is 388. You are just removing risk by $8. It's really useless. Okay, so then it seems that we are in a situation that, which is what I was expecting. I think I said at the beginning of the session, we're in a situation where we need to go straight into butterflying. Yes, we are too close to expression. That's the problem. And I believe I also said that last week when we put the trade together. I said that the beauty of our 1 week trade is that, you know, the probability of being right is quite good. Typically, the front week also have more implied volatility than other expiration dates, and it's okay. But the problem is that if the stock does not behave the way you need it to behave, there is very little you can do from a management point of view to mitigate the problem and, you know, do those tweaks and do all those things that I was explaining. There is little you can do precisely because of what we see. Precisely because we see that since expression is very close, the premiums available are very disappointing. Okay, so that's you know, pros and cons, like everything in life. Okay, and now we are seeing it, which is, again, I'm very excited we are having this problem because it gives me the opportunity to explain it. So, you know, you don't need to go through this by yourself, and when you see this, you don't understand why. So now it's happening and we are understanding why. So now, what do we need to do then? Well, then we need to be all the way aggressive when it comes to the risk management, because this trade seems to be looking like it's not behaving. So we are going to try to offset this trade the most we can. And the way to do that would be to go ahead and match the 330 strike, okay, and sell the 330 put all the way here, and therefore buy the 325 below. Okay, because by pushing the strikes all the way higher, so instead of 20 cents and 11 cents, so now we're going to get 1, 2, 3, 2.5 and 117, okay, which is now making the risk of the trade to become, you can see here, 253, okay, is the worst case, versus, let me put here, 250 versus 388. So now we are reducing the risk much more substantially, even though, again, if we had used an expiration date that was 1 month out, 3 weeks out, and we did that after 1 week, the improvements would be so much better because you have much more time to expiration. But that's what we have. Okay. Now, in this case, we can say that the reduction of risk is, I would call it, worth it. But I'm not clear on if doing this tweak is actually a good idea or not. Okay. Well, the rules suggest to do it. The rules suggest to do it, and again, I'm gonna explain what I mean by that. The rules suggest to do it because the probability cone is surpassing the purple area. Okay, because the probability cone surpasses the purple line, it's time to change to damage control mode. But while the timing of the change of strategy is in place, we also need to use common sense. If it doesn't make sense for us to do the tweak because the reward risk ratio, the risk improvement, etc., is not sufficient, then you don't do it. Even though from a timing point of view, it's time to do it, you may need to give up on it because it doesn't provide an advantage. And in this case, the advantage, as I said, it's worth it. Going from a risk of 388 to 254, assuming the trade is going to end up as a loss, it's worth it. But there is one thing which is not worth it at all, and therefore my conclusion is going to be we're going to wait one more day to see what we do here. And here's why. Notice the new break-even points of the iron butterfly. If we do that, those are the new break-even points. And let me explain a bit more what that means. So the original break-even point is right there. The new break-even point is right here. So we are just giving this trade very, very tiny extra room of breathing space for us to end up in a profit. Okay. But what's really killing me is not that, because that I would take it. Look, a trade went against you. You give it a little bit of extra room. It's okay. Thank you. But you're not going to be able to give it too much because it went against you. So I'm okay with that. But what's killing me is, what if these trades come back to the range? Well, remember, we just entered the space between the red line and the purple area. This is where our red UFOs are. That stock could very easily turn around and tomorrow or the day after be back inside the purple area very easily. Okay, very, very easy. That's why we set up the trades this way, because there are UFOs there for this to happen. But next thing you know, if the stock does this actually, okay, and with the new butterfly, the below break-even is 328, the above is 331, the below is 328. So take a look at where is 328. Okay, 328. Let me adjust it. So 328 is around here. So in other words, if that stock goes a bit higher, the UFOs kick in, comes inside, and stays here, great, you profit. But if it goes lower than that, which is very near, well, it's very sad, because you're in the purple area, which is the original profit zone, and you would actually lose. Okay, you would actually lose those $288, I believe we said. So I'm very unhappy about the fact that the new location for break-even points above and below is so disappointing. Again, no complaint about the upper side that went from 331.12 to 331.89. No complaint about that. But the big complaint about the bottom break-even point that was all the way down at 288, creating a major wide purple area of profitability, where now the new break-even will be 328, which is so near to 331. So not happy about that. And again, the reason why that's happening is because the premiums are low, because we are too close to expiration. So what I'm going to suggest to do is to wait until tomorrow. I'll keep this risk graph until tomorrow. We will re-examine this tomorrow. We'll see what the outcome was. Okay. And to be able to re-examine and compare yesterday and today, I'm just gonna copy this to the position graph without executing the trade. So I'm just gonna put it there. I'm gonna put it there a bit lower, just so I remember that it's there for me to observe. But this is not like I converted this trade into that trade. I'm not doing it. Okay? But we will talk about this tomorrow, because again, I've seen that many times, and it could be the day tomorrow that we see the market go down. We see Facebook go down thanks to those UFOs. So remember, we saw on the S&P, a little bit of bearishness coming from the options data. So we could see that that market go down, and then that means that if it goes down, to let's say 327, something like that, you will be in a very nice profitable situation. You would be in a very nice profitable situation, and we would just close the trade tomorrow, and that's it. Okay. Or if not, if we see a lot of bullishness coming in the S&P, and that stock, is barely here in the middle, so maybe we can then do the butterfly and end up with a little bit of a wider range, because we're gonna be selling new puts, and the lower the stock, the more premium for the puts. So again, if it drops tomorrow, no matter how much, as long as it drops, it's gonna give us a little bit of an advantage. Okay, so I prefer to not to do anything, because this would be one of those cases where you see the market kind of come back a little bit, and now it's killing you even more that if the market went against you, which is what's happening now. So we are just gonna leave it. We are overlaying on top of our timing rule for damage control mode. We are overlaying common sense in the sense of not doing anything. Okay. What about rolling up and out? You could, and again, rolling up and out may be understood in different ways, depending the trading book that you read or the video that you watch. Okay, so let me do it. Okay, so I see if we are basically referring to the same, Joe. Yeah, got you. So I'm gonna edit that spread again, and basically what I believe Joe refers to is, what if instead of just doing it like that, what if we reverse it all the way, and instead of dealing with 330, 335, we go all the way to, let's say, 345 and 340. Okay, so we are now selling in the money puts instead of out of the money puts. Okay, so let's take a look at the graph. Okay, let's take a look at the graph. Okay, and yeah, the graph now it's giving you profitability on the right now if the market was to continue rallying. Okay, but now if the market stays somewhere in between, notice that now the risk of the trade would actually get worsened to 450 instead of 388. Okay, and again, why is that? And again, maybe you can pick strikes that are a bit nearer, and then it would be a bit softened, but it's not going to be that amazing. Okay, and I mean, I would not expect it to be that amazing. Why? Because again, we are very close to Friday. Okay, so and the best thing that could happen here is those UFOs to kick in. That's the best thing that could happen. Okay, let's try if I do 340, 335. Okay, so now the trade is underwater. Okay, we are underwater. You lock in a loss. No matter what, you lock in a loss. So that is too low. So then maybe there is a strike in between that was $2.50 above. So what if I do 242.5 and I do 237.5? So if I was to do that, so now you have a little bit of a profitability, but still the worst case is still a worse loss than expected here, the orange line below the blue line. So it's not really helping, because putting on the side the complexity of these, and now you are dealing with in the money options, nothing that complicated in the end, but it's more complex than what we were doing before. On top of that, now you're adding risk instead of removing risk. Again, with longer expiration dates, you could have ended up with a different scenario. Okay, you could have. So that choice is not a crazy one at times, but typically you do need, let's call it, maybe you were doing an Aaron Condor that was like 45 days out, something like that. So that's when you may get setups of this sort that work. When you are dealing with very short expiration dates, most of the times it's not going to be the case unless you have this major spike of volatility or something. Makes sense, Joe? I believe this is what you meant, but again, rolling up and out, I've seen it explained in various ways, including contradictory ways in places. So just want to make sure that this is what you refer to. Yeah, I mean, Christian, I'm with you. Waiting for tomorrow is nothing wrong with that. Okay, it's not about procrastinating. It's about using common sense. If the tweak is not gonna help that much, Oh, out in time. Got you, Joe. Let me come back to you on this. Um, um, I kind of lost my chain of thought. Yes. So remember, when we entered this trade, we had a value of risk that was already pre-calculated. It was 388, and if we took this trade, it means we were okay with that. So waiting until tomorrow will not make that worse. In that sense, we are not doing anything which is against professional behavior, right? So if you work for a hedge fund, you are a hedge fund trader, your portfolio manager gave you a risk management rule, which is maximum risk 388, 400, whatever, and this trade is not surpassing that, you won't get fired, right? If you were to tweak the trade in a way where now you lose more than expected, even if it's only one time, you get fired immediately. Correct? So we are not doing anything which is against a professional behavior here. We are just using common sense on top of our timing rule for the tweak. And the reason why is because the tweak, given the short expiration date, the tweak does not provide significant benefits. It actually provides, to me, a greater amount of risk because, yeah, you reduce the risk in dollar amount, but the probability of being outside that triangle space is very high because the triangle space is very narrow. And therefore you are almost locking in a lower loss, but it's a lower loss. It's not giving the trade a second chance. And in the definition of damage control, which I never read that definition in the dictionary, but if I was to make it up, I would say the definition of damage control should be reduce the risk while you put yourself in a position where you can still win. Okay, not only reducing the risk. Okay, and therefore that tweak was not meeting that criteria, and that's why I discarded it, and we are waiting until tomorrow. Got it. Yes, Mark, you are right. That's what Joe meant. So now, why would I suggest not to do that? Okay, well, first of all, doing that to me is a little bit of a technique that suggests that you are negating or you are not willing to accept what is happening in the market. Okay, which may not always be the case, but think about this for a moment. If that stock had remained in the purple area, not only that means that the stock was nice to us and behaved nicely, it also means that the stock remained with the same conditions we used to do the scanning even before the trade was executed, where the scanning at that time had us look for neutral and neutral type of strength parameters. So if that stock now it's piercing the purple area in less time than was planned based on the probability cone and the expiration date and so on, that means that that stock is not behaving neutral any longer. That stock is now picking up strength in any of the directions. So start rolling out in time trying to save the trade could certainly work from a mathematical point of view. You roll out in time, you get more premium, the premium reduces the risk, the strikes are still the same, or maybe you move the strikes a little further out, and you keep playing with that, and you may get lucky at some point and you end up in a profit. But the reality is that you need a bit of luck here because the market condition has changed and that stock is not neutral any longer. And therefore, to me, as a trader, I'd rather be out, take my loss because I was proven wrong objectively. The probability cone surpassed the purple line. The price is outside the purple area. I am objectively proven wrong. Why don't I put my capital into a trade that is likely going to do better instead of just trying to fix it? That is not the philosophy of damage control mode. Damage control mode is reduce the risk and give the trade a second chance instead of trying to fix it by going up in time, which to me has a very a pretty important hope component because there is more time. So there is hope attached to, hopefully with more time now it works. Okay. So again, I think it's a dangerous thing. While it could work, it's a dangerous thing from a concept and behavior and building of good habits for traders in general. Brokers will love you to do that, and brokers teach to do that because it's more trades, it's more time in the trade, it's more capital tied up, it's more margin if you are hedged, it's more commissions on more contracts. But from a trader point of view, to me, it's either I'm right or wrong. Okay, so that's again my 2 cents. Now, before we conclude the session, just so we can see it visually. So if I was to do that, Iron Butterfly or the Condor, right? So moving it up to what we said it was going to be 312, right? So if we did a 312, 305, okay, and we did instead of December 10, December 17, okay, things will look different, okay? So you are reducing the risk on that side, you are increasing it on the other side, okay? But I mean, you could also manage that when it goes down to roll the other side to the next expiration date, and that would balance out. So I'm not too concerned about that. You are reducing your risk, okay? But notice how the improvement of break-even point, sorry for that, it's not that significant either. Okay, so that's that's why I'm not so convinced about this type of action. While again, in very special cases where some expiration date, some strike got lots of premium, so then next thing you know, it could look quite different. Okay, but in this case, you can see it's not that spectacular. And then the last thing I want to say before we go, because it's time to go. Actually, it's time to go. It's time to go to meet Josip. Okay, isn't it? I hope you guys are registered for the webinar that we are doing in 30 minutes time. Josip will be talking about the advanced synthetics. Okay, so hopefully you guys are ready for that. But the other thing I was going to say is that if we're going to use December 17, right? So now I need to be looking at my probability cone here on December 17, and December 17 is actually pointing at 309 as the lowest point that could be achieved in this trade. So in other words, the 312 I sold is actually not good. If I was, and we need to go and check UFOs, but let's assume we have UFOs at 309. I'm just gonna make it okay 307.5 because I don't have 309. So you do 307.5, and then you do. I don't have 302. Okay, so I guess I'll do 310, 305. Okay, which is a bit more optimistic for the trade. But you will see how, again, the improvement of the break-even point, it's very, very little. Now it's actually less. Why? Because you are selling options which are a little further out. Okay, so not ideal to do that unless there is some very special case with an excess of premium, and then you can do it a bit better. Okay, so anyway, hopefully this makes sense, everyone. Let me see the remaining comments and questions. Mark, yeah, I'm with you. It's creating a new trade to you. I get it. Doesn't need to be like that if it's part of your plan. Okay, so again, if you have a set of rules that lead you on how you roll out in time, so it doesn't need to be seen like that. Now, I don't have that set of rules, and I just share my philosophy, so to me, it does feel like that. But I could certainly understand and respect 100% from another trader that has a set of rules to do that and plays it, because there is a little bit of an advantage to be gained. But again, based on what I said before, it may be against the market conditions. So you improve the risk management, but you are not really giving the trade a second chance, or too likely going to have a second chance, because the benefits for the exchange of extra time and extra premium are very limited. Okay, so yeah, so again, it's all about having the rules, having back tested it, you know what you got in your hands. With certain stocks, with certain moments, with certain levels of volatility, it may work well, but most of the times I would say this is what you get. Okay, good. So guys, we're gonna complete the session here. I see Ahmed is asking for a link for the webinar, so let me share that with you. We emailed everybody. Okay, so if you never received the link for the registration, that may mean that email is in your spam folder. Please go ahead and take a look for future emails that we will send you. But in the meantime, I'm just getting the link here so I can share that with you guys. Just give me one moment. Okay, so I'm just copying this on the chat box. Yeah, that's it. It's there. Okay, so you have it there, Ahmed. Mario, thank you, Jose. Thank you, my friend. And Mark, your rules are complicated enough. You are right. you could argue options is complex, and you could also argue that you could trade options simplistically by using the strategy builder and doing no other maintenance, and that would still be better than trading stocks, isn't it? But again, if you are, I know you are, Mark, if you are a passionate lover of options, so these complicated rules, I think you love them. Yeah, you don't know what advanced synthetics are, is because, Christian, this is what is going to be explained in the webinar. It's synthetics are cool, but they are very, how do I say it? It's either black or white, and there is very little you can do with it. There is very little tweaking you can do with a synthetic, but there is another way to construct them, which make them a variation of what a synthetic is, which is certainly much more interesting. So I do suggest that you attend the webinar, and if you cannot make it, make sure you are registered with that link so you will receive the recording and then you can watch it. Okay. And we'll have Josip in this room as well from time to time. Okay. So you guys will have time to work with him too. My friends, you guys take care. See you tomorrow. And for the ones of you that have time, see you in 25 minutes in the webinar room. Take care, my friends. Bye-bye.